Brett. How's it going?
Good, Russell. How are you doing, man?
Doing well, doing well. Excited to get back here for Ask a CPA. We've got our business discussion on OB3, right? The one big beautiful bill. And
Yeah,
OB,
you're still the only guy calling it OB3, but I love your commitment to it, and you're like, you got it. You're really pushing this. You're gonna make it stick. I like it. I told a guy today at lunch, it's the OB3 bill. He started laughing. He's like, "What is that?" Like, I don't know, man. My buddy keeps calling it OB3, and I'm trying to support him and back it up. So, yeah, I love it.
it's
OB3.
going to
Let's
catch
do it.
fire. It's going to catch fire. We're going to get to that tipping point, right? And it's going to catch fire.
Yeah.
But yeah, so we're going to talk about this, the business deductions here. But before we jump into that, how's your summer been?
Good,
I
man. We
saw.
just got yeah,
Oh,
we
go
just
ahead.
got back from vacation down at the beach, and we're building a pool right now. So they're started digging a couple days ago, and excited for that. It'll be perfect time for winter. We'll have a pool. It should all be done by the time it gets cold. That's good, but it's gonna have a hot tub, so we'll use it all year.
There you go. There you
The
go.
kids are pumped. They like playing in the dirt and keep climbing down in the hole, and like they think it's really cool. I remember when my
Nice.
parents built a pool, and like I still have those memories of like climbing down into the hole and be like, "This is awesome! Like this is really cool." So I'm sure they're making good memories, but. Yeah, man.
There you
All
go.
good. Been having a good summer. How about you?
Been pretty good so far. Had a little quick vacation with the family and got that out of the way. We're back into the sports tryouts and all of that stuff. So it's like this impending doom of practice every night and all of that coming
Oh,
up.
man.
So that'll be fun. But I did see your great video here that you did on the Ask a CPA channel about it was a great backdrop. So you're sitting there in your short-term rental with the ocean behind you talking about
Yeah,
short-term rentals,
man.
right? So
This short-term
uh,
rental loophole. Love it.
there you go.
That's a good one. Yeah, if you haven't checked that out, yeah, it's on the channel, man. So go find it. It's a big one. I think people overlook that a lot, especially high income earning W-2 employees aren't taking advantage of that. We get asked that a lot. Like, what's a good way to lower my tax liability? Like, I make a ton of money. I'm an executive at this company. Yeah, use a
Uh-huh.
short-term rental, man. It's a great way to maximize those expenses. You can, use a cost segregation study to break that up and maximize the depreciation, offset your W-2 income. It's a huge planning opportunity. I talk to real estate guys about it all the time, and they're like, "You could do that? Like, I didn't even know that was a thing." And you're
Oh
like,
no.
"Yeah, man. Let's chat.
That's wh- that's why you
Let's
need
get
a
in there."
CPA.
That's right. There's so many little tricks, and not necessarily tricks, but the tax code is written to put these things in place to incentivize you to do these things. They want you to invest in real estate. They want you to start businesses. They want you to invest in the infrastructure and hire employees. So they incentivize you to do that. So you should take advantage of these tax advantages and use them to your advantage.
Yeah, absolutely. Well, and it's a good segue as we jump into the business side of this OB3 bill because there's a couple of provisions in here that are great for all businesses. They really do help out the short-term rental play quite a bit. Like you mentioned, the cost seg studies and those kinds of things. And we'll jump into that too. But yeah, let's dive into this OB3 bill because I think there's a lot of good stuff in here. There's a lot of stuff that we all kind of thought maybe would happen, but like you just never know what's really gonna come out of these bills as they kind of go through Congress, go through the House, go through the Senate. You don't always know what's going to come out on the other side, but I think everybody was pretty happy with this one.
Yeah, I think so. It kind of similar to the individual podcast that we did where we talked about all of the individual incentives and tax changes that went into this OB3 bill. If you haven't watched that, go back and watch that one because that'll impact everybody. This one's more focused on business owners. But yeah, I mean, the main portion of the bill is extending the Tax Cuts and Jobs Act changes from 2017, 2018. A lot of those were set to expire at the end of this year. So this is extending those or making them permanent and then kind of adjusting a few things that people didn't like or that, kind of simplified a couple areas. So we'll get into those. But yeah, overall, I think it was a really business friendly tax bill, and on the individual side too. I think it really incentivizes people to do the right things. With the increase of the SALT deduction, and
Hmm.
I think that's going to increase the amount of charitable contributions because more people are going to be closer to itemizing, which will really help a lot of these charitable organizations, which should be good. So,
Well, you also get that charitable contribution deduction outside of itemizing too, right? So they
right.
brought that back and increased it. I think almost tenfold from what it used to be several years ago. So I think that's a big help for sure, and I really enjoyed seeing that. I know some people I'm close with that work in some nonprofits, and they just got decimated when
Mhm.
the 2018 bill came out and really increased those. As soon as everybody realized they didn't need to donate to charity anymore, then it was a little bit more difficult to kind of get those last few dollars at the end of the year out of folks.
Yeah.
Those charities really need to survive. Well,
Right.
let's dig into this thing. So the biggest change, I think, if you kind of had one kind of theme on this bill, it's going to just be like finally made all this stuff permanent after a couple of decades now of temporary rules and sunsetting and when does it sunset and what percentage does it sunset, those kinds of things. And the one that everyone's the most excited about being permanent is 100% bonus depreciation. There's just no doubt about that. Everyone really wanted that, and at least wanted it extended. And then it came out that we're going to talk about making it permanent, which was just great news for people like us that are doing kind of multi-year tax planning, right? Like your Excel formula doesn't have to be quite as complicated, when we have some of these rules being permanent.
Right. Yeah, you're exactly right. It's huge for real estate investors. It's huge for small businesses that are buying equipment or automobiles. Everything about 100% bonus depreciation is fantastic. It allows you to take losses below zero. So if you're just starting a business, or you're having to buy a bunch of equipment to kind of get the business off the ground, you can take those losses against your other income or W-2 income, active income, assuming you're active in the business, which is huge. 179 will allow you to take it to zero, but it won't allow you to take it negative. So bonus allows you to
Yeah.
take all of it against your other income. So that's pretty awesome. Yeah, I mean, we were all pumped to see that because it was dropping to 40% this year,
Yeah.
which is not much when you're buying $100,000 piece of equipment. You get a
Yeah.
$40,000 deduction when now you get to take that full 100K, which is great.
Well, it's a
Yep.
big play on the short-term rental, right? So this is one of the great benefits of the short-term rental is that you can do the cost seg study, like you were just talking about. For those of our listeners who don't know what that is, it's really just taking the purchase price of a piece of real estate and parsing out its pieces, right? So you got a little bit for land, you got some for the structure, and land is not depreciable, and the structure is depreciable only over 27 and a half years. But everything else, you've got all the equipment, all of the build out on the inside. You think cabinetry, countertops, those fixtures, but also the equipment like the HVAC system, the hot water, anything that's equipment related, the appliances, all of that stuff. Then all of that becomes, you kind of parse all those pieces out. And so you can then now bonus depreciate all of those pieces. You still can't bonus depreciate the structure, right? So there has to be an allocation to the structure. Still can't depreciate the land at all. There's got to be an allocation to the land. But everything else, now you can take that bonus depreciation up front. So if you think about a structure, let's say it's $500,000 or $600,000 in purchase price, maybe a little bit more, then you can get a couple of $100,000 usually in that bonus depreciation category if
Yeah.
you get the cost seg study done right. And the key there is you need a cost seg study, you need to do it right. It's a big, huge tax benefit, but it's also being big, huge tax benefit. It's something the IRS is going to take a look at if you ever get under audit. So you want to have that paper to back it up.
That's right. Yeah, usually it's 20 to 30% of the purchase price. That could be a huge tax deduction. You buy $1 million property and you get, two or $300,000 tax
Hmm.
deduction on in year one that can offset your W-2 income. So that's a huge play, especially for high income earners. We have clients that, they'll buy one every year and it just helps
Hmm.
offset. And then they have this real estate portfolio. It's huge. Yeah, and check out our friends over at 24-hour cost seg. They do them for like $500
Yeah.
for residential properties. That's a steal. That's a good deal, and it'll save you a ton of cash.
Yeah, absolutely. Absolutely. Help you get that papered up. Make sure if you ever do get under audit, you've got the paper to support what you're doing there. So another big one, if you're talking about multi-year tax planning, another provision that was about to sunset was Section 1. 9A, also known as the Qualified Business Income or QBI deduction. And that one was about to sunset too, which, so back in the day, little history, is 2018, we dropped the corporate tax rate way down to 21%. But then what are you going to do about, S Corps and partnerships and sole proprietors who didn't get that same reduction in that corporate income tax rate because it gets taxed on their personal tax return? Well, they came up with this QBI deduction that essentially just takes a haircut off that income in order to kind of bring some parity between these different entity types and how much of their income is taxed. But the problem is that it's sunset, right? So the corporate tax rate didn't sunset, but this one did. So and so what are you going to do about it? Well, there's kind of this like impending doom for a lot of people. This is a 20% off your income tax deduction, right? So it was a big deal. You and I both have businesses, right? And we both really love this QBI deduction. So, I mean, even I personally was looking at this thing thinking, man, if they get rid of this thing, my taxes are going to go up, by a fifth. Like, that's crazy.
Right.
And so thank goodness they made this permanent. So that was a big one.
Yeah, that's a huge one. And they didn't change the corporate tax rate, so it remained at 21%. There were some
Yep.
talks about adjusting that. There were some talks about adjusting QBI up, and I think maybe the House proposal included it going up to 23%, and then the Senate knocked it back down to 20%. So it's remaining the same, and it's now permanent, right?
Yeah, that's right. Permanent.
Yep.
That's the big kicker there.
Yeah. Yeah, that's huge. Yeah, that's a really, really good deduction. And there are some limitations on this. Of course, on most of the stuff we're talking about today, there could be limitations. There is limitations on the QBI deduction depending on your income. So, check with your CPA. If you're not working with a CPA, reach out to one of us, and we'd be happy to walk you through these and see how they impact your personal tax situation. Everybody's situation is different. My situation is different from Russell's, and every client I have is a different tax situation. So you really need to kind of run these through and do a projection and calculation to do real tax planning.
Mm-hmm.
It's good to be aware of all the different changes and to see how they're going to impact your return, but to see how this is really going to impact you want to work with a CPA and make sure that they're running these numbers for you and giving you good advice based on that.
Yeah, if you have a high income, this QBI deduction gets a little bit tricky, and the interplay of wages and an S corp versus a partnership, like an LLC partnership, or even disregarded it in the $150,000 band. They're all fairly similar, but as you get to the high income numbers, that's when like some stuff starts to phase out, and some entities are better than others, and that's really where we get to earn our keep, is helping you kind of walk through that. So if you're a high income earner, and you've got a partnership or a small business, a partnership, sole proprietor, or an S corp, and you're not working with a CPA, then with this being permanent, it's definitely going to be a year you need to really think about it.
Yep, absolutely.
So another big one I thought of was this R&D credit, which, man, these rules on the R&D credit, research and development credit has a lot of effect on software companies, but really anybody who does any kind of trial and error kind of work in their business, right? So they're developing new tools or new processes or new software. All of those kind of qualify. And the 2018 rules, they just changed it to where it made it to where we needed to capitalize, which just means that you don't get to expense it immediately. You get to capitalize those expenses and then amortize them out over a period of time. And one of the biggest problems I have with a lot of my clients is that I've got a lot of small business clients, and even these are companies that $1, $2, $3 million a year in revenue, but they're not spending a whole lot of money on some of the software that's needed to really track this at a granular level, and that's really what it required to kind of follow the rules. And so it was always a headache. It was always a problem, and really limited, some of the benefits of doing R&D, which is kind of like a bad spot to be. Like, we're in this new age of AI and, developing all these new apps and all this other stuff. And then here we have this tax law that basically, kind of kneecaps you a little bit on like, yeah, you could do that. We really want you to do that, but we're also going to hose you on taxes because you're doing the thing that we want you to do. Like, it didn't make any sense to me.
Yeah. Yeah, it's huge. And the R&D is really quite expansive. I mean, it of course anybody doing like biotech or medical is kind of what you think of when you think of R&D, like some person with like a Bunsen burner, and I don't know what what you think of, but
Yeah,
that's kind of what
exactly.
comes to my mind. But it also applies to software development. You have to meet certain tests to qualify, but it's more expansive than people think, and software development is probably one of the biggest ones where it qualifies and where you can get the biggest deduction. So yeah, this is great. You don't have to capitalize it anymore. The rules are still kind of up in the air as to how we're going to treat the prior ones. So the past few years, we've been capitalizing
Mm.
these and then amortizing them. So I'm not really sure if we're going to have to go back and amend, or if we're going to be able to file, at 3115, a change in accounting method to move to expensing those, and then being able to catch up and just go ahead and expense those prior years where we've already capitalized them and we're starting to amortize them. So we're still waiting on some guidance from the IRS, and I'm sure they'll be coming out with that soon to let us know how exactly we're supposed to treat those for tax purposes.
Yeah, that's a good point. There's a huge tax planning opportunity there, especially if you had some high income years in the past and had to amortize the R&D cost, or like what you're talking about, what we call a 3115 or accounting method change, being able to expense that accounting method change all this year. So if you have a big income year at 25 and they allow us to do that accounting method change this year, being able to front load all those expenses this year if you've got income. So big tax planning opportunity there to kind of weigh what the best option is. Going back and amending, expensing it all now, or just letting it sit and amortize for those historical costs while taking the R&D credit or the R&D expense today. Again, if you're not working with a CPA, this is one of those big opportunities in order to really save some taxes by doing so.
Yeah, and the rules on R&D credits are complicated, so you definitely want to work with a CPA who's qualified, knows about R&D, has done these credits before, and knows how to calculate them and present them on the tax return to minimize your risk of any audit exposure. It's really important that you work with somebody that knows what they're doing. Yeah, let's take a look at another one. Are you familiar with the QSBS 1202? Qualified small business stocks. This was one that wasn't even on anybody's radar that they were going to change. Some people even talked about maybe they're going to drop this or cancel
Yeah.
this deduction because it's almost too good to be true. So what this is if you're a C corporation, and the prior rules before the OB3, I was about to start calling it one day. I'll keep
Good. See,
your title, the OB3.
I've got one.
Yeah, so before OB3, it was if you were had original issued shares of a C corporation stock, you held those shares for 5 years, and then you sold those shares in a stock transaction, you could exclude up to $10 million of capital gains on the sale of those shares. So they were really trying to incentivize people to invest in startup companies and hold it for a long period of time, and then eventually sell it, and you could exclude this huge capital gains. It would typically be probably 20%, either 15 or 20%,
Mm-hmm.
depending on your total income. So they made a few adjustments to QSBS. So first, they increased the total amount that you can exclude, so it's up to now $15 million, and they adjusted the time period as well. So you still get 100% if you hold it for 5 years, but if you hold it for 4 years, you can get 75%. If you hold it for 3 years, you can get 50% exclusion. I mean, that's a really cool planning opportunity. We were just talking about tech companies, and that's a huge one. So if you're developing a software and you're like, this is either going to be a $50 million business or it's going to be nothing, right? You know,
Yeah.
but it's not going to cost you anything. You can just go on and develop this yourself. You can code it. You don't have to buy a bunch of equipment. You don't have to buy a bunch of advertising. There's not a lot of startup costs. You're not buying big equipment that you can depreciate and offset your other income. Yeah, set this up as a C corporation. You have original issued shares. You hold it for a period of time, and then if it becomes valuable, you can sell those shares and exclude, a huge portion of the sales. Hopefully, you sell it for more than 15 million. But if you sell it for 15 million, that's a home run, and then you save 20% of that. Being able to do that is pretty awesome. And then even if you get an offer 3 years in, you can exclude at least 50% of it, which is really cool too. So the expansion on the QSBS, I think, is a really neat thing that they added to this kind of late in the
Yeah.
game, and nobody was really really expecting that. So, and I haven't heard a lot of people talking about it, but I think it's really cool. And you can even, if you think, oh, this is going to be $100 million idea, you can give shares to other people. As long as it's original issued shares, so you could give shares to your children, or you could set up irrevocable living trust. It has to be irrevocable. You couldn't do it with a revocable trust, but you could stack trusts and you could put shares into each trust, and you can exclude, as much as you want, how many trusts you want to set up.
Mm-hmm.
So yeah, that's a really cool planning opportunity, and I think it goes overlooked quite a bit.
It's one of those planning opportunities too. I think where it really highlights how it's important to talk to a CPA early. And look, I talk to people in startups all the time, and I'm sure that you do too. And we're not out to like try to hose people on fees when you're trying to get your business started. You know what I mean? Like that's not what we're about. We're about long-term relationships. It's you come in, you talk to us early. We're gonna have a consultation with you. We're gonna talk to you about some of these things. And if there's an opportunity to save you a lot of money, then that's going to be great. But we're really in it for the long-term relationship, right? And so, and I think that if you're working with a CPA that has that mindset, then coming in early, talking to them about these things, making sure that you get it set up for success early on, maybe that's one of those provisions, right? It doesn't save you really any money today, right? And so it's not like a really short-term outlook, but if your business does blow up, man, you're going to be so thankful that you took that 30-45 minute meeting, with a
Yeah.
CPA and started working with them early, because it's going to save you potentially millions of dollars in taxes, which is
It
unbelievable.
There are so many people that don't know about that code section and
Yeah.
about that exclusion amount. I'm sure there's people that sell shares out of a C corporation every day and they pay taxes on it when they didn't have to. I met with a
Yeah.
lady the other day. She was like, "Oh, I sold some shares. This company got bought out that I had, new shares and that I invested in early on." She goes, "So I'm gonna have to pay capital gains on that." I said, "Well, was it original issued shares? When did you purchase it? Did you hold it for 5 years?" "Yes, yes, yes, yes." "Well, let's get the CFO on the phone and let's talk to him about QSBS and make sure that see if this qualifies."
Yeah.
And yeah, he was blown away. He had no idea. It's like
Yeah.
everybody, all these shareholders now don't have to pay any tax on this, and you almost just totally overlooked it. And
Yeah.
it can be huge, and it's surprising how many people don't know about it.
Yeah. Yeah. That guy better be sending you a nice bottle of something. That's for sure.
I hope so, man. I'm still waiting.
Yeah. So I just talked to somebody as well that an older gentleman who was starting his third company, had sold out two really successful companies, and I'd mentioned this to him, and he was like, "What is that again?" And I talked to him about it, and then like 2 days later, he calls me back out of the blue, and he was like, "Is this for real?" I was like, "Well, yeah." And he's like, "Well, how come I've never heard of this?" I
Yeah.
have no idea why you've never heard of this, but yeah, he was blown away. He was blown away. He'd been really successful in life, sold two really really big companies. I mean, we're talking 7-8 figure exits, right? And so
Yep.
he was starting a third one, and he was just blown away. He was like, "So are you sure?" Because he was, to be set up as a C corp, it was, he was like, it's like, "I've never done that before." And I was like, "Well, you told me your plan, and your plan is to sell in 5 years, so this is a good one."
That's the way to do it.
Oh,
There's yeah. And most people don't want, if you're gonna run at a loss, most people say, "We'll just set up an LLC. Those losses come through to you personally. It'll help you personally in the short term.
yeah.
But if it takes off, man, it can help you big time in the long term if you structure it as a C corp."
Yeah, yeah. And this guy had he was just doing the same thing he'd done before. Like he just like lived out his non-compete, and he was ready to go and do it
Yeah.
again. He's just cookie cutter, right? It's gonna rinse and repeat. So it's pretty high likelihood that he was going to be successful in some form, right?
Yeah.
Uh, well, I think we got time for one more here. I think we'd be remiss without talking about the PTE election, right? So pass-through entity PTE, and for anybody that's in an income tax state, most states allow you to have an election to pay the taxes instead of with an S corp or partnership, instead of that income flowing through to your personal return and paying state taxes. Now, this doesn't change anything for federal, but state taxes at the individual level, you can elect to pay them at the entity level, and this is really great for people who have partners who are out of state, right? So you've got several partners in this entity, and some of them are out of state. So if you live in Texas, like you don't want to go file a Pennsylvania tax return, right? That's not something that's on your list of things goals in life, right? So this allows you to pay it at the business level, slightly higher tax rates, so not quite as favorable rates usually, but allows you to pay it at the business level and get that money as a deduction. So not only do you not have to, your partners don't have to worry about filing a tax return in a state just for a single K1, but it's a federal tax deduction. And with this expanded standard deduction that, I mean, yeah, the SALT limit's gone way up, but why not just push those state income taxes over to the entity level and then take the standard deduction, get a little bit of extra deduction there on the personal side as well. And I think for a lot of people that if you live in a state like that and you don't have maybe a high mortgage interest or really high charitable contributions, then this is great because you can collect that state income tax deduction on the business side and still maybe get an extra $15,000 or $20,000 deduction on the personal side. So, it's not life-changing money, but you start adding these things up and it's good. And look, nobody wants to tip the IRS, that's for sure. And so they get enough money in there. But I really think this is a really good one, especially for those states. You think New York and California, being those kind of high state income tax states, but there's a lot of them, right? So a lot of, Pennsylvania, Ohio, Iowa, some of these states that you don't really think about, kind of those Rust Belt states that still have, pretty reasonably high state income tax rates. And so if you got a business there, this could be a really good one for you.
Yeah, that's a great one. And that was really big, especially when the SALT deduction was much lower. People were really, trying to jump on that, and you still should use that as a planning tool. But yeah, they expanded on that, so that's great. Cool. Well, this was a great one, Russell. There's lots of big changes, and we're still kind of absorbing all of this and reading a lot about it and trying to see how this would apply to clients and what strategies we can take. How can we implement this? We're watching CPEs, watching other CPAs explain these things and trying to absorb as much information as we can. So continue to watch the channel, watch the podcast, and make sure you're subscribed and hit that bell notification so you get notified when new videos come out. Yeah, we'll continue to update throughout. We have some big plans for this podcast. We have a couple guests that we're gonna bring on here and learn some more about from other really smart CPAs. I mean, we're probably the two biggest brains in the CPA community.
There's no doubt.
But there's some really sharp CPAs out there. So we'll bring some good guests on and kind of pick their brains and see if we can't come up with some other good ideas to help minimize people's taxes and do what's best, keep some more money in your pocket.
That's it. Well, until next time, Brett, we will see you later, bud.
All right, man. It's a good one. Thanks, Russell.
Bye.